So this is, if it's Swiss francs, this is going to be about a $65 billion market cap in US dollar company. PE is really low. Forward PE is 14. This is in the material sector. They're a building material company, and they're a worldwide company. Cements, clinker. Okay, cool. Okay, so first, one thing I would mention is, one thing that I would really recommend is pick the sectors and the industries you want to own. For me, materials is not a sector or industry that I want to own. I'm very careful not to buy too many companies like this, if any at all. I own one, which is TX. I'm actually lowering my investment in it. Why is that? I think that over time, these businesses, this one's been a really good one. It's up 72%, 3% dividend. So this one's a very good company. But I want just awesome companies. I want this consistently over the 5 years. I want that. Okay. And if you bought here, you're up 500-600%. So I'm looking for this, and I'm not going to find, this type of company in materials. So we're going to look at this company, but just be aware, I probably wouldn't be an investor because it's in the wrong sector, in the wrong industry. I'm not looking for more material companies. I don't think I'm going to be able to double my money every 5 years investing in material companies. Most of them are just going to be okay investments up over 5 years at a rate of return of 6 to 10%, which is okay for most people. But hey, why not go after something that's going to appreciate far better? So this company is a good size market cap company. PE looks great. Looking at their financials, and this is very normal, right? This is materials. You have periods when construction happens and it goes up, and then construction doesn't happen, revenues go down. And more recently, the revenues have been going down. So semi-annual, the worst, 6-month period they had was probably about a year and a half ago, and their revenues went down 11%. So that's a little bit of a concern. All right, so the economy isn't great. I think Scott, before he disconnected, said that they might be divesting a business, the one that in the United States. Maybe that's where they're not growing as well. They want to get rid of that. From a free cash flow perspective, they are a good free cash flow producing company. 3.9 billion in the trailing 12 months. That's very good, very good. And this type of business, to me, they'd be worth 40 to 60 billion. So they're right there. They're valued fairly. This is a fairly valued stock and has some upside if you believe in the company. But first and foremost, if you're a younger investor, go look for the next Meta, go look for the next Google, go look for the next NVIDIA, because you're not going to be perfect. You're not going to be like, oh yeah, I picked 5 stocks and all of them are up, 500%. No, you'll be like, hey, I picked 5 stocks. One of them is a superstar. It's up 1,000%. And then one of them is a total loser. It's down 25%. So you sell that one. And the other ones are kind of in between those two performance curves. But you really got a hold of that 1,000% winner by looking in the right industries and sectors. This one here is a very conservative sector, materials. They're going to be around forever. We're going to need them forever. But you can see that their growth isn't really exciting. And if I'm going to be in a stock like this, I'd rather be in treasury bonds or bonds in itself. They give me a good rate of return. I don't have to deal with the adversity of ups and downs of the stock market. Although this company has been performing very well. So those are my comments on Wholesome.